Everyone, I'm Steve Savant, host of the Business Insurance Zone. All this week, I'm going to have as my very special guest, Sheryl Moore, the #1 authority in indexed annuities. On this show, we're going to talk about caps, spreads, bonus rates, and participation rates. Sheryl doesn't hold back as she attacks the games that carriers play. You won't want to miss our show today. Welcome to the Business Insurance Zone. Brokers Alliance and the National Insurance Clearinghouse present the Business Insurance Zone, a Bravo video event. Broadcasting in HD 1080p on Vimeo, YouTube, the Insurance Newsnet, Agent Navigator, brokersalliance.com, and on Facebook, LinkedIn, Twitter, and the Insurance Forum. And now your host, the whiz of the biz, Steve Savant. Well, welcome everyone to the Business Insurance Zone, the talk show that spotlights insurance in your practice, keeps you up to speed on insurance news and products, features insurance strategies from top advisors. Get in the zone, the Business Insurance Zone. Our email address is thebiz@brokersalliance.com, or you can call us toll free 1-800-290-7226, extension 147, for any of your questions or quotes on life insurance, DI, LTC, annuities, and of course group pension. Remember, I'm not a tax or legal advisor, so before moving forward with anything you hear on our show, always consult your CPA or attorney, and of course if you're a registered rep, you always want to check in with your compliance officer at your broker-dealer. Today, and this is day 4, with the goddess of all that is indexing, please welcome Sheryl Moore to the show. Sheryl?
Thanks, Steve.
Day 4, how you doing? You hanging in there?
Fabulous. I love Arizona. It's just beautiful here.
Yeah, except for I can't talk you into moving, can I?
No, I love Des Moines. You'll never get me to leave.
Of course, we're broadcasting from Fountain Hills, Arizona, home of the largest fountain in America. So just a little shot of it there. And I just want you to think about, we're talking about indexing. Now, if you missed our shows Monday, Tuesday, and Wednesday, we did talk about indexing,
right,
but it was indexing on a life insurance chassis.
Right.
Now we're talking about indexing on an annuity chassis. A little bit different tax issues and so forth. But a lot of the things that we talked about there, we're going to talk about again today, but it's going to be different because it really, annuity is nowhere near it. For example, first question out of the box, I'm sorry, it's my big one. Why can I show such big caps on life insurance, big par rates, and when I come over to annuity land, it's like so small, it's half those numbers?
Oh, not even half, Steve. Good question. Right now, my average cap on an annual point-to-point indexed annuity is 4.04%. My average cap on indexed life is 12%. Here's the reason for the disparity. When you look at an annuity, there's only one way insurance companies can make a profit or a spread. And that's through what are bonds paying right now and what am I crediting to my policyholder. The difference is the spread. On a life insurance product, the insurance company can make a profit through several other ways in addition to the spread, through cost of insurance charges, premium loads, policy fees, percent of fund charges. So where you can absorb some of that cost through some of those other things on a life insurance contract, you can't on an annuity because there's only that one way to make their profit. And for that reason, the caps are going to be much less aggressive.
So even if I had a long-term index annuity, a 10-year, it still doesn't matter?
No, it really doesn't. And really what you need to understand is the longer term surrender charge you have, the much more advantageous rates you're going to be able to have. But in this really depressed low interest rate environment, it doesn't matter how long you're using for your surrender charge. The caps aren't going to be that nice.
Well, I mean, the rates are, indexing still is probably beating the fixed index.
Oh, absolutely. The fixed annuities current average rate is only 3.4%.
Oh, yeah, it's pretty brutal out there. And I think the 10-year lockdown rate's like only 3.9.
Yeah.
So when I'm looking at that, though, I kind of noticed a new trend in the index spreadsheets, and our own is included. They're adding these bonus rates at the front end to kind of for kind of a first year enticement. Mm-hmm. Talk a little bit about that, because I'm not used to seeing bonus rates on the index annuity.
Mm-hmm. Well, bonuses are something that's really become prevalent on both fixed and indexed annuities because independent agents have demanded it. Mm-hmm. Over 70% of all indexed annuity sales have some kind of bonus.
That came from the field?
Absolutely.
So we actually get our way once in a while?
More often than I'd like to admit, Steve.
I'm shocked and scandalized by our pull.
There you go. Now, the bonuses are essentially, they started as a premium bonus, where if the client pays $100,000 into an annuity and it has a 10% premium bonus, on the first day, their account value would be increased to $110,000. Well, that's a risk to an insurance company to be able to offer such a high incentive in the first year, because some insurance companies say, well, what if the client cash surrenders in year 2? We don't want them to be able to make money off of this. There's a certain amount of risk for us. So what we've seen is some insurance companies innovating with their bonuses and offering different types of bonuses with the proliferation of guaranteed lifetime withdrawal benefits, or what some agents call income riders. We have a whole new type of bonus that's erupted in the indexed annuity market, and that's a bonus that's credited to the benefit base or the income value on the indexed annuity, but that bonus is not available on cash surrender. So there are a few products on the market right now where you can see a bonus as high as 25%.
Now, should I start making a partition between the income index, which you just said, because there's a credit, but that's only at distribution.
Right. Well, you need to look at the case.
Think differently?
Because me, I'm years old. And so I don't need the income because I'm going to be taxed and penalized if I take it out before age 59 and a half. So is income my ultimate
you're
goal?
younger than 59 and a half.
Yes. I'm 59 and a quarter.
Okay.
So my annuities are for accumulation.
However, Steve Savant, your host, who is above 59 and a half, I'm so sorry to say, I have an income issue.
Okay.
Probably.
So with the income issue, yes, it is a great idea to have two different values that you're referring to, and especially when you explain it to the client. These cash values are the values you can access through pulling money out through penalty freeze, through cash surrender. That's the amount that's going to be paid to your beneficiaries on death. This income value, or what I like to call the benefit base, is the value that's going to be available to you once you decide to turn on your income. And now remember, this is something that I developed on indexed annuities as an alternative to annuitization. The guaranteed lifetime withdrawal benefit on an indexed or fixed annuity does not work like it does on a variable annuity. Because on a variable annuity, you're using that optional benefit to provide a safety element to a risk money product. On fixed and indexed annuities, we already have a guaranteed return of principal. What I'm offering the guaranteed lifetime withdrawal benefit on these products for is as an alternative to annuitization. So I can still get the guaranteed lifetime income every month, but I'm not locked into those handcuffs of annuicide.
Well, so if I guess the big thrill of not having to be locked in on annuitization is a major player. I love that.
Yeah.
But is the income withdrawal features, and again, I don't want to get too much into the policy features as much because I'm trying to see how does indexing play better on a platform like this? We know how we talked about Monday, Tuesday, and Wednesday show about how it plays on a universal life insurance platform. But this is a little different.
A little different, but the same in that when I'm looking at an indexed annuity, we price them to return 1% to 2% greater interest than what fixed annuities are being issued at today, regardless of whether you're using a cap, a par, a spread, S&P 500 versus NASDAQ 100, or annual point-to-point versus monthly point-to-point. That is how we price the indexed annuity. Do I have annual statements that show a gain of 45.67 in a single year on an indexed annuity? Well, yeah, I do. But that's because not everybody knows what the market's going to do a year from now, or certainly not 10 years into the future. But over the long haul, an indexed annuity should return 1% to 2% greater than a fixed annuity.
But still, with the cap, I mean, I'm thinking the largest cap. What's the biggest cap you've seen out of the market?
9.05 right now.
9.05.
Right.
That's the largest cap, and no other restrictions. It's 9.05. That's what you get.
You get 100% of the market's gain up to 9.05.
That's the cap. Now, what's your leading par? Your participation number?
I don't know. Probably about 45.
Nothing bigger than that, though. No. So if I had your 45% return, like you said, I'm getting.
Right. If the market goes up 45%, you get 45% of 45%. But if the market goes up 10%, the client's going to receive 4.5.
Gotcha. 4.5% is now. Anybody doing spreads on annuities?
Oh, absolutely. Because
that's kind of hot right now.
Yeah, that is, and that's something that's not used as much on index life chassis. But on index annuities, spreads have become really popular since the market collapse of 2008 because people want to be able to take advantage of the upside movement in the S&P 500 or NASDAQ, what have you, without limit. So what a spread does is says the insurance company charges a fee annually, typically, and that is deducted from any index gain. So if the product has a spread of 3%, the market goes up 20, the client receives 17%. Okay, if the market goes up 4, the client only receives 1 if their spread is 3. And if the market goes down, they don't lose 3%. They still get 0.
So what's your top spread then?
Oh gosh, I got to tell you, there's a lot of disparity, and it depends on the surrender charges of the contract too. In 2008, I had spreads as high as 27%.
They're out there still. I'm looking at this.
No, not still.
Not now. I mean,
not
I was just
still.
thinking that now.
And you have to look at the crediting methods too, Steve. You're more apt to see a spread on a monthly or daily averaging crediting method, where you're more likely to see a participation rate or a cap on an annual point-to-point. On a monthly point-to-point, you'll only see a cap.
Now, when I'm just looking at one of our annuity spec spreadsheets that we generated before the show, and I'm looking at the bonuses that are paid here. Now, these carriers that we're looking at, this isn't an income bonus for the benefit. These are straight up bonuses, right?
Absolutely.
Now, of course, coming with a 9% bonus, I'm looking at a couple carriers here, 9, 8, oh my goodness, 10% bonus. However, you got to hold for 10 years.
Right.
And the early surrender charges are punitive. I mean, they are big numbers here. I mean, look at 10, 9. These are big,
I laugh at that statement, Steve, because back in 2004, as recent as 2004, I had first-year surrender penalties as high as 26% on indexed annuities.
Wow.
And bonuses as high as 18%. It really is a different world today, and that's largely due to regulation. There are so many states in our nation which have now said we are going to ban any annuities that exceed a 10-year surrender charge or anything greater than a 10% penalty in the first year. And so that's really dominated product development in the annuity arena. That applies to fixed index and variable annuities in about, I'd say, 13 different states.
Well, so I'm looking at the cap rate, the par rate, and the spread. And it's changed. So we're down in although 9.5 is pretty nice cap.
Yeah.
I mean, that's a pretty nice cap.
But that's the best.
Right. Would that cap include, though, a bonus like these that we're talking about?
Right. The way it would work is immediately, if there's a 10% bonus, your account value is increased to $110,000, and then if the market goes up 9% or more over the next 1 year period, you get the 9% credit on the whole 110.
When we come back with Sheryl, we're going to talk more about this because I think this is a huge issue. I want to talk about the caps, the par, the spreads, and the bonus rates and the surrender charges because we're trying to figure out what's the best for the client. That's our end game. Listen, you're listening to the Business Insurance Zone. I'm Steve Savant. When we come back, we'll talk with Sheryl Moore about all these subjects because we want to make sure when you're looking at this annuity spreadsheet that you're getting the most you can get out of it. It's a great due diligence package. Steve Savant here. For years, I've heard that less than 2% of all term life insurance ends in a claim. That's not many, and clients had to die to receive the benefits. That's the old term insurance. Now start selling the new term insurance. The term insurance that covers your client through a chronic illness, a catastrophic event, or a terminal diagnosis, and pays their monthly premium during extended periods of unemployment. What term life insurance can do all that? Western Reserve Alliance Advantage Term with living benefits. No other term insurance product bundles so many solutions to life's unexpected problems. And all in one policy. So for more information, call Brokers Alliance 1-800-290-7226. Stop selling the old term. Start selling the new. Well, welcome back to the Business Insurance Zone, the talk show that focuses on insurance in your practice. I'm Steve Savant, your host, financial color commentator, and interviewer extraordinaire. I just want to remind everyone that you can watch this show and all our shows in HD 1080p, wow, high def, Vimeo, YouTube, Facebook, Twitter, LinkedIn, and the on-demand section at brokersalliance.com. And our email address on the show is thebiz@brokersalliance.com, and you can call us toll-free at 1-800-290-7226, extension 147, for any quotes or questions you have on life insurance, DI, annuities, LTC, or group pensions. And remember, I'm not a tax or legal advisor, so before moving forward with any of the planning strategies, always check in with your attorney, your CPA, and before going forward, especially if you're a registered rep, always check in with your compliance officer before moving forward with any of the strategies we talk on the show. We're back again with Sheryl Moore, the creator and founder of Annuity Specs, which is a huge due diligence spreadsheet, and I like to say the true grid out there of all that is index annuities. And since index annuities pretty much is the dominant player right now.
Right.
I mean, not too many people are doing MGY or
Well, we have
MYGA
MIGAs and fixed on
Yeah.
annuityspecs.com also, but it originated because of the indexed annuities. And today, 4 out of every 10 fixed annuity sales are indexed annuities.
4 out of 10. Now, see, that surprised me. I thought it would have been more.
Well, you have to consider there are a lot of companies that don't offer indexed annuities and a lot of companies that distribute fixed annuities through banks.
Well, I'm thinking, when I'm looking at this, when we talked about these, I never understand if I'm happy with a high cap or is it a cap trap? If I'm a bonus, I have this 9% bonus, like on this one that we're looking at, 9% bonus. Yes, I have to hold for 10 years. Yes, it's punitive. I want to get out early. But if I'm willing to hang tough for 10 years, getting a 9% bonus, and as you said, these index annuities were priced and designed to be about 200 basis points over whatever the interest rate market, somewhere in that vicinity, that's not a bad deal if I can hold.
No, but what everybody needs to understand is if you're looking at an annuity with a bonus on it, all things being equal between two annuities, one having a bonus and one not, the one that doesn't have a bonus is going to have much more attractive rates. So maybe the cap on the product with the bonus is 4%, but the product with no bonus, maybe the cap is 7%. Well, now I have to introduce another element into there and say, okay, you've chosen whether or not you want the bonus, but how long are you willing to keep your monies with the insurance company, or lock in, as you say, and then what is the renewal rate history going to be on the indexed annuity?
I think that's the big controversy of all this whole renewal rate issue, because there's bait and switchers out there. I mean, there are carriers that I have to say that aren't really very, I guess, client-based, consumer-based, because they seem to play the first-year billboard rates. And then after that, it just drops down to the bottom.
It's gotten to be quite a controversy over the last few years, especially while interest rates have been so predominantly low. But it's unfortunately become a result of our independent agent distribution. The insurance agent just needs to know that he needs to do his due diligence in checking the integrity of his company's renewal rate history so that he can avoid that uncomfortable conversation later on.
Well, here at Brokers Alliance, and of course, our head of our entire annuity division, Eric Palmer, is nationally known. The guy's a complete gun in this area, and here having him on our shows all the time, of course, having you on here, we're trying to up our game as it sounded, I thought I heard a little negative aspersion cast there on independent market organizations like ourselves. But we're trying to educate, because we have a thing called edutrainment, and we have educational videos out, and we want to always make sure our guys and gals that are selling, our producers, have a really good understanding of the products they're selling, and to so much so that we have this now on several other sites, educational only. And so it's not like our show here is a little more salesy, a little more marketing oriented, but it's educational.
Well, I'll tell you, Steve, you're not the benchmark that everybody else is currently working against. They should be, though. Okay, there are a lot of marketing groups who maybe aren't doing their due diligence and training their agents about issues like bait and switch on renewal rates. As a third-party expert, I do not endorse any company or financial product. I'm happy to help you and your agents in their understanding of these products, but what they need to know is that's a very important consideration when deciding who to partner with, because not everybody is doing it like Brokers Alliance.
Well, now I'm looking at something like, and I thank you for that shameless plug, okay? But now I'm looking at some of these areas, where I look at the guaranteed rates, because a lot of people say, well, okay, I know I'm not going to get zero, so now what are my guarantees? And when I'm looking at a contract, let's say I don't use a bonus rate because I want the higher participation. I'm going for the better number. What is a good number that I should look at that seems to be reasonable on the floor rate?
Well, every indexed annuity that's available today has a floor of 0. I've had indexed annuities in the past that have floors of 1%, 2%, or 3%, but in the current interest rate environment, you just can't find that, because the higher your floor is, or the higher your guarantee, the lower your indexed interest will be, or the lower your caps or pars. So today, every indexed annuity has a floor of 0. But we have a secondary guarantee that comes into effect on index annuities, and that's the most confusing thing for most agents.
Yeah, in fact, actually, it's so confusing I didn't frame it right. So why don't you walk me through that, because I think that's what confuses me.
Okay. Well, the secondary guarantee on an indexed annuity is payable only in the event of death, surrender, or if the index doesn't perform. So when you're comparing it apples to apples on an indexed annuity versus a fixed annuity has a guaranteed minimum floor of 2%. An index annuity has a guaranteed minimum floor of 0%. But the index annuity has a secondary guarantee. We call it a minimum guaranteed surrender value, or MGSV. That's a value that's determined by the National Association of Insurance Commissioners for standard non-forfeiture purposes. It says that the contract cannot receive any less than 1% interest on 87.5% of the premiums paid into the contract.
At death,
At death, surrender, or if the index goes down every single year. Okay?
or negative index.
Right.
Okay.
So that interest rate, though, could be as high as 3% on 87.5 of the premiums paid.
Why did they pick that number? It sounds like an arbitrary number, 87.3.
That's the standard non-forfeiture loss. But when you look at what determines whether it's 1% or 3%, that's the 5-year constant maturity treasury rate, the 5-year CMT. Basically, when interest rates are good, it's going to be closer to 3, and when they're dumpy like they are right now, it's going to be 1. And how does that play out? Well,
Is that, by the way, is that an official quantifiable word, dumpy?
yes.
Dumpy, I like that. Dumpy. Hey, that's like you have rating services. What's your rating? Dumpy.
Dumpy.
Good. Yeah, I love that.
Well, when you look at the current interest rate environment, usually carriers are at 87.5 to 1% on their minimum guaranteed surrender values. But let's just say 87.5% of premiums paid credited with 3% interest. What that means is that the client's going to receive a return of premiums paid sometime in year 4. Worst case scenario, if the S&P 500 went down every single year for 10 years, your entire surrender charge period, in year 4 they'd be able to cash out and get back their whole 100,000 premium. And if they keep it for the entire 10 years and don't receive any index gains because the market goes down every year for 10 years, they'd get a return of premiums paid plus 18% interest, which is exactly why we offer that secondary guarantee.
So 1.8% or whatever that is. Okay.
Exactly.
So really, that's the worst scenario because of the way they've instituted secondary guarantees.
Exactly.
I really don't think we understand that. I think that's a good way of explaining it, guarantees on an indexing. So whether it's death or surrender charge, right? Or it's actually the maturity date, and the indexes went negative every year. You didn't get anything credited. You're still going to get this.
Exactly.
Now, do you see, most people, because of our rates being, as you say, dumpy, everything's pretty on the floor right now, isn't it?
Yeah, I mean, like I said, our average cap right now is 4.04%. And that's another reason why we're seeing some of those big bonuses, because annuities are commoditized. Let's face it, it's all about the rate. Lately, in the index annuity market, it's become about income. But when you're looking at rates, how can you tell the client, hey, if the market goes up 4.04% or more, you get 4.04. But if it goes down, you get 0. That doesn't sound like an attractive value proposition when they could get a bank CD for 10% back in 2000. So what a lot of insurance agents are doing is choosing products that have premium bonuses, say of 10%, where maybe in the first year they're allocating all of the client's premiums to the fixed bucket. And then they can say that they can guarantee them a first-year yield of 12.58 because it's got a 10% bonus.
I guess I'm okay with that on the income side of that equation. My living benefit, my income stream, right? Because I get the bonus. I know I'm going to use it later on. It's not part of my actual surrender cash value. I get that. But it's going to be used as a calculation for my income. I kind of can appreciate that. It's the other side where I'm doing accumulation. It's the billboard rate to get me to come into the. That's what scares me.
I understand that, and you also have to understand that typically big bonuses mean you're locking in for a longer period.
Now let's just say I agree with let's do the accumulation side first. I agree with the accumulation. I see the bonus. Now I know my cap rate's going to go down because that more than likely.
Right.
You usually don't get a big bonus and a decent cap. All right, so it's going to go down.
Trade-off.
Now, if I look at that, going back to our design issue, that this was designed to be about 200 basis points over whatever the current interest rate market is, if I thought I was already in that game with my bonus rate, I might be okay with that. Now, the flip side is this: could I pull off the same number without a bonus, but I have a higher cap rate, and do I think I'm going to play at the S&P or whatever index I use?
Well, I'll tell you, I have a lot of people who argue with me on this point, Steve, because
that's why I brought it to your attention.
I'm a fan of bonus annuities, but here's why. I'm 30-something years old. I'm not retiring anytime soon. And quite honestly, call me a pessimist, I don't trust the integrity of the renewal rate history of the insurance companies that I'm buying annuities from, maybe. So I'm going to say, give me the biggest bonus possible. I'm not retiring anytime soon. I don't care about the longer surrender charges, because I don't trust that if I choose the product with no bonus and higher caps comparatively, that maybe that cap's going to stay as high in years 2+.
How I just fear to say this word, on a contract. When I think of contract, I think of legal language.
Right.
On a contract, I can change on my annuity contract next year's cap.
Well, that's just like a fixed annuity, Steve.
Yeah, I know, but I'm just thinking like when I keep thinking of life insurance, I'm locked in, but in annuity land, I can't think in the same way. So it's
you can do it on life insurance too, though.
It's going to vary.
Yep. After
year.
the contract's sold. If you're using an annual crediting strategy, whether it's index life or index annuity, annual point-to-point, monthly averaging, you can change the rates.
No, I know you can change it. I'm worried about the carrier.
That's what I'm saying. The insurance company can change the rates every year.
Yeah, that to me is so unnerving.
But that's just like fixed UL or fixed annuities.
But I guess I'm just thinking of.
I think that's why you love the guaranteed UL so much.
I guess I do. For indemnification, okay.
Right.
But I guess what I'm trying to our consumers who might pick up this show, because we're getting picked up on YouTube on this show now.
Yeah, you bet.
I want to make sure they understand what they're getting themselves into. We like it.
Right.
It's just that we want to be able to pick companies, especially what you just said, the renewal rate. We should do a whole show if we could find out the historicity of the carrier. I mean, if we could really get that.
I have renewal rate histories in writing from several insurance companies.
I mean,
but that's from doing my due diligence as an insurance spy, Steve.
So they didn't offer it.
No.
Of course.
There are a few companies that do.
I appreciate that. And the people that are really offering it and the tell-all caveat carriers are the ones I really want to play with. Well, listen, tomorrow we're going to have Sheryl on again. We're going to talk more about index annuities. We're going to break apart her top-of-the-line annuity specs balance sheet to really make sure we're completely informed on all the policy provisions. And I mean, this has become our Bible here. I mean, we have to use this every day. I'm Steve Savant. You're listening to our show. Don't forget, hop out on our website at www.brokersalliance.com. You've been listening to the Business Insurance Zone. Well, that's the buzz on the biz for today. Get into the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.